If you blinked this week, you missed it. Silver didn't just move, it detonated through a psychological ceiling that's been mocking people for decades. And here's the part that should make you sit up straight. Triple-digit silver is not the headline. It's the smoke alarm. The real story is what started changing underneath the surface, while most people were distracted by stock tickers and election noise. And before we go 1 inch deeper, I'm running a campaign to eliminate copycat channels. If you actually value these breakdowns, support the campaign by subscribing right now and drop Our John AG in the comments so the algorithm knows who the real community is. Now, today is Saturday, January 24th, and the time right now in New York is 4:48 p.m. Comment what time you're watching this because I love seeing where the community is tuning in from, and it also tells me how fast this message is spreading. All right, silver punched above 100 on spot and didn't just tap it, it settled up there. That's a milestone, sure. But milestones are what tourists take photos of. Investors ask a different question. What had to break behind the scenes for that to happen? And what's next? Because the market never gives you a clean, comfortable, now is the time sign. It gives you a messy chain of clues. And today we're going to connect them. We're going to talk about why silver suddenly started behaving like a must-own asset again, what it signals when silver starts outrunning the stock market, why gold is quietly doing something even more dangerous to the old narrative, and why the dollar's next move might shock people who think the party is guaranteed to continue. And yes, we're going to talk about the uncomfortable part too. When something gets hot, it attracts hype, it attracts leverage, and it attracts traps. If you're here to get emotionally pumped, this is not that channel. If you're here to get mentally armed, you're exactly where you should be. One more quick thing before we get into the numbers. The description has bonus links, including a premium WhatsApp channel link where we drop extra updates, and a channel membership join link if you want deeper content and access. Keep those saved because later in the video I'm going to explain why the members side is going to matter more than you think. Now, let's start with the obvious headline, silver above 100, and then immediately move past it. A lot of people will look at triple digits and say, well, it's expensive now. That reaction is normal, and it's also exactly how people miss generational moves. Because price is what you pay, positioning is what you build. The better question is, expensive compared to what? Compared to groceries? Compared to houses? Compared to stocks? Compared to the money being created? That's where things get interesting. But first, I want to address something that matters a lot for viewers outside the United States, especially those who've been sitting on the sidelines because of taxes. If you're in the UK, you already know this pain. You buy physical silver and you get hit with VAT at the standard rate. That's not a conspiracy. It's literally how the tax rules treat most silver bullion while investment gold is treated differently. And for years, people have used that VAT as the reason they can't stack silver. They'll say, why would I pay 20% on top? I'll wait. Here's the reality check. If your thesis is that silver is moving into a new regime, you don't get to hide behind the VAT excuse forever. Because once the price starts climbing fast enough, that VAT becomes background noise. It becomes the fee you paid for the privilege of being early, not the reason you stayed late. Let me put this in plain language. Imagine you bought a kilo bar years ago and you grumbled about the tax. Then silver doubles, then triples, then does what it just did. At that point, your brain stops fixating on the tax line item and starts fixating on the fact that you own ounces that other people suddenly can't get at a reasonable price. And that leads into a new problem, one nobody talks about when silver is boring: security. When silver was sitting down in the nobody cares zone, it was easy to treat it casually. A 10-ounce bar on the desk, a chunky bar on a shelf, no stress. But as the price climbs, the same object becomes a different category of asset. Not because it changed, but because the world changed around it. Think about it. A bar is the same bar, but the incentive for someone else to take it is not the same incentive anymore. So, without going into brands or sponsored names, let me just say this. If you are stacking physical metal, you need a plan for storage that matches the new reality. You need layers, you need discretion, and you need to stop advertising your holdings by accident. Now let's pivot to the bigger clue, the one that matters more than a headline price. I want you to imagine silver not as a number, but as a competitor in a race, and the other runner is the stock market. Because when silver starts accelerating relative to stocks, that's not just silver doing well. That's capital changing its mind. That's money starting to question the story it's been told. So here's a ratio that reveals what's happening. Silver priced as a percentage of the S&P 500. When that ratio rises, it means silver is gaining ground against the market that everyone worships. And lately, that ratio has been breaking out in a way that should make you pay attention. Now, does that automatically mean stocks are about to crash tomorrow? No. And here's where I'm going to challenge one of the easy narratives. A rising silver to stocks ratio can happen because silver is exploding upward, even while stocks drift or even rise. In other words, the ratio can scream, risk is changing, without guaranteeing an immediate stock market collapse. But the reason I still take it seriously is that ratios change regimes. They don't blip for fun. When hard assets start outpacing paper assets, especially after a long era of the opposite, it's often the early stage of a much bigger rotation. And if you think I'm exaggerating, zoom out. In previous eras, that ratio has reached levels that would sound insane to people today. That's not a prediction. It's a reminder that the range of outcomes in markets is wider than most people's imagination. Now, here comes the cliffhanger you need to hold on to. Silver isn't moving in a vacuum. It's moving because it sits at the intersection of money fear and industrial reality. And those two forces are starting to line up at the same time. Let's talk about that industrial reality for a second, because this is where freshness matters. Silver is not just a monetary metal, it's a working metal. It's in electronics, electrical components, and increasingly in energy infrastructure. In fact, industrial demand has been a major driver, with electronics and electrical demand hitting record levels in recent years. And one of the biggest industrial pipelines for silver has been solar. The solar industry has been consuming massive amounts of silver, numbers that would have sounded extreme a decade ago. That matters because when investment demand wakes up at the same time industrial demand stays firm, the market doesn't need a perfect storm to tighten. It tightens anyway. And it gets even tighter when you look at the plumbing. Annual silver demand has hovered near 1 billion ounces, with total demand around 1.16 billion ounces, and industrial demand setting new highs as discretionary buying cools. When you're dealing with a market that size, a few percentage points of extra investment demand isn't a little more buying. It's the difference between comfortable supply and a scramble. Also, supply is not as flexible as people assume. A meaningful chunk of annual supply comes from recycling, and that stream doesn't magically double just because the price is exciting. There are bottlenecks, collection, refining, and the time lag between I should sell and metal actually shows up as bars again. And when the market has been in deficit for multiple years, those bottlenecks matter more than the headline price. Then you have inventory. People argue about whether inventories are high or low, but what matters is accessible inventory at the point of delivery. Recent reporting highlighted major exchange inventories dropping into an uncomfortably tight range and described tightness in major vault systems after years of drawdowns. If you're hearing there's plenty of silver, but you're also watching inventories get leaned on, that's the kind of contradiction that shows up later. Now, let's talk about the other side of the coin, speculation. Silver just had a surge that some outlets described as a frenzy, with huge percentage gains last year and another sharp burst early this year. That tells you two things at once. First, this market can move violently upward when the crowd discovers it. Second, this market can also punish late arrivals when leverage gets too concentrated. Both are true at the same time, and if you only see one side, you're walking blind. Here's my practical rule. When silver goes vertical, I stop asking how high can it go, and I start asking how deep could the shakeout be without breaking the bigger trend, because that's where risk management lives. And if you can't answer that question, your position size is probably too large. But there's something else most people miss. Silver isn't just reacting to hype, it's reacting to the same macro forces that are pushing gold. That includes the shift in how investors think about policy risk. Even big institutions have been bumping up longer-term gold targets on the idea that private money and official money keep diversifying. And when gold's backdrop improves, silver tends to get pulled like a trailer behind a truck, sometimes smoothly, sometimes with a violent snap. So the real cliffhanger is this. If the policy environment turns more support the system at all costs, what happens when millions of people decide they want hard assets at the same time? That's not a philosophical question. That's a supply question. And supply questions don't get solved with opinions. Now, I can already hear someone in the comments saying, but if silver is up this much, isn't it overbought? That's a fair question. And yes, when silver moves like this, it's normal to see pullbacks. It's normal to see violent shakeouts. Anyone telling you it's straight up forever is selling you a fantasy. But pullbacks inside a new uptrend are not the same as a top. A pullback is the market checking who's serious and who's just chasing. And this is where most people get emotionally wrecked. They buy because it went up, then they sell because it went down, then they buy again because it went up again. That loop is how you finance someone else's gains. So what do you do instead? You shift the way you think. You stop staring at price and start tracking signals. Signal 1, the ratio we just discussed, silver gaining ground against stocks. Signal 2, the way gold is behaving. Because while silver is stealing attention, gold is doing something that changes the entire frame. Gold is hovering just under a giant round number level that would have sounded impossible not long ago. And I'm not saying that number for shock value, I'm saying it because psychology matters. When gold approaches a historic threshold, it pulls in new participants. Not just retail, but institutions that have mandates and models that force them to react when certain levels break. But again, the better way to see gold isn't just the spot price. It's gold relative to stocks, the way we did with silver. Gold versus the S&P has been pushing into territory that suggests the old stocks always win story is losing its grip. And historically, when gold starts outperforming broad equities over longer windows, it's often because confidence in financial engineering is eroding and confidence in real scarcity is returning. Now here's another cliffhanger. Gold doesn't need the dollar to collapse to rise. That confuses people. They think gold only goes up when the dollar goes down. Reality is more subtle. Over long stretches, gold can rise even as the dollar index stays firm, because the dollar can be strong compared to other weakening currencies, while still losing purchasing power against real assets. So yes, a falling dollar can accelerate metals. But the deeper driver is trust. Trust in policy, trust in debt, trust in the future purchasing power of a unit. And that brings us to the dollar itself. The dollar index has been flirting with a key breakdown zone, and when the dollar gets weak, it acts like lighter fluid on anything priced in dollars, especially commodities. But I want to be careful here. Even if the dollar doesn't collapse, the next policy choices can still push hard assets higher. Why? Debt math. Let's talk about something that rarely gets discussed in casual market commentary: interest expense. When a government runs huge debt loads, even small changes in rates change the cash flow reality. And recently, interest costs have been setting uncomfortable records. Now, I'm not saying that to scare you. I'm saying it because it limits options. When interest expense balloons, policymakers start searching for solutions that often look like financial repression, keeping nominal rates controlled while inflation runs hotter, so the real burden of debt shrinks over time. In plain English, the saver gets punished quietly so the system can keep rolling. And this is where the conversation about the next central bank leadership and policy direction becomes more than gossip. Because markets don't just trade the present, they trade the next policy regime. There's been growing chatter about a potential future central bank leader with deep ties to large asset management and a clear bias toward liquidity support, lower rates, and tools that can cap longer-term yields. That includes the concept of yield curve control, where the central bank effectively draws a line in the sand on how high certain bond yields are allowed to go, and then uses balance sheet power to enforce it. If that sounds technical, here's what it means in real life. If the bond market tries to demand higher yields to compensate for inflation risk and fiscal risk, the central bank can step in, create money, and buy bonds to hold yields down. That protects government financing and supports asset prices, but it can also weaken the currency over time and push investors toward hard assets. And now for the twist. Wall Street tends to love this kind of candidate, not because it's independent, but because it's predictable. Liquidity, backstops, support. The same movie, just a new actor. But here's my skeptical counterpoint. Yield curve control is not magic. It can suppress yields, but it doesn't erase the inflation psychology that can build when people realize the currency is being sacrificed for stability. So if we go down that path, the first reaction might be risk-on euphoria, but the second reaction can be a flight to real things. And that's where silver and gold come back into the center of the story. Now before we go further, I want to ask you something, and I want a real answer in the comments. Do you think triple-digit silver is the start of a new era, or the final burst before a painful shakeout? Don't just drop a one-word answer. Tell me why you think what you think. Because here's what's fascinating. Mainstream narratives always show up late. When silver was cheap and unloved, it was a relic. When silver turns violent to the upside, suddenly everyone has an opinion, everyone has a chart, and everyone has a reason you're supposed to be scared. We just saw headlines about speculative frenzy and warnings of a correction because silver ran too far too fast. And to be fair, corrections happen. But the deeper question is whether the correction, if it comes, is a reset inside a bigger move or the end of a bubble. And that answer depends on structure. Structure means, are there real, persistent buyers underneath? Are industrial pipelines still demanding supply? Are investors using silver as an alternative monetary asset again? Are inventories and refining capacity tight enough that price spikes are not easily solved by supply? Recent commentary has pointed to tight physical conditions and depleted inventories after years of deficits. Again, that doesn't mean up only. It means the market can move faster than people expect, and it can stay volatile longer than people can stay patient. And patience, by the way, is the hidden edge. Everyone wants the gain. Almost nobody wants the boredom, the doubt, and the ridicule that comes before the gain. So, if you've been stacking for years, you understand this. If you're new and you're just now paying attention because the price got loud, understand what you're walking into. A market that can swing wildly and punish weak conviction. Now I want to shift to gold for a moment, because gold is often the quiet leader that tells you what the broader monetary environment is doing. Gold has been climbing with a mix of investment demand and official sector interest, and forecasts for major institutions have been moving upward as well. Whether you care about forecasts or not, what matters is that more people are being forced to reconsider gold's role as an insurance asset, not a speculative trade. Central bank buying has stayed elevated in the last few years, and recent reports show that net purchases remained meaningful into late 2025, with monthly buying still robust. That matters because central banks don't buy gold because they're bored. They buy gold when they want fewer dependencies and more neutrality in their reserves. And this feeds directly back into the silver story, because silver often acts like the higher beta cousin of gold. Gold moves first, silver eventually overreacts. Now you might be thinking, okay, gold and silver are moving, so what does that mean for stocks? Here's where nuance matters. Stocks can keep rising in nominal terms even while you lose purchasing power. Stocks can rise because money is chasing returns, because buybacks keep propping prices, because liquidity keeps flowing. But the real question is, what are stocks doing relative to hard assets? That's why ratios are so powerful. A stock index can make new highs while still losing ground to gold. And if that happens, the celebration becomes a little hollow because the measuring stick changed. Now, let's talk about another ratio that people love because it's brutally simple, the Dow to gold ratio. This ratio has a long history of swinging between extremes. When it's high, it suggests stocks are expensive relative to gold. When it's low, it suggests gold is expensive relative to stocks. The ratio doesn't tell you the exact timing, but it tells you where you are in a long cycle of confidence and fear. And recently, that ratio has been slipping in a way that suggests the pendulum is swinging back toward hard assets. That doesn't guarantee a crash. It suggests a repricing of what people trust. Now, if you're still with me, here's the part that ties the entire story together. And this is where most people will either lean in or click away. Silver above 100 is not just a commodity story. It's a signal that the public is rediscovering an escape hatch. It's a signal that the old game of save in currency and you'll be fine is losing credibility. And at the same time, the policy world is boxed in by debt, interest expense, and political pressure to keep the system stable. So what do policymakers do? They usually choose the path of least immediate pain. That means more liquidity, lower real rates, controlled yields, and tolerating higher inflation narratives while managing the optics, which is exactly why hard assets become attractive, because they don't require you to trust a promise. They require you to own something real. Now, let's bring it back down to you, the viewer, because this isn't an abstract academic discussion. This is your financial life. If you're stacking physical metal, your job is not to guess the top. Your job is to build a position that you can hold through volatility. Your job is to avoid the emotional whipsaw. And if you're building any kind of portfolio, metals, stocks, cash, real assets, you need to think about one concept: resilience. Resilience is what survives multiple futures. If inflation stays hot, you need assets that don't get vaporized. If growth slows, you need assets that don't depend on perfect economic conditions. If markets panic, you need something that isn't someone else's liability. That's why people own gold. That's why people own silver. That's why some people own land, energy exposure, and other hard assets. Now, I'm going to say something that may bother extreme metal purists. Not all hard assets move at the same time. And sometimes, the laggards can be the next opportunity. Energy is a classic example. People assume energy stocks only matter if oil is high today. But equity markets price expectations. If investors start anticipating a future rebound, they can re-rate energy even before the commodity fully recovers. And it's not just oil, it's the whole resource complex. So why mention this now? Because when metals rise, it often signals broader commodity repricing. Silver surges, gold climbs, and eventually other commodities catch up as money seeks real things. But I also want to be honest. You can be early. Markets can stay irrational, and they can stay slow, and they can keep frustrating you. Which is why strategy matters more than bravado. This is also where our members-only videos come in, and I want to mention this once, clearly, without turning this into a sales pitch. We offer members-only videos produced by a separate team that goes deeper with more research, more charts, and more context. And those videos are only for premium members. If you want that level of detail without cluttering the main channel, the membership link is in the description alongside the premium WhatsApp channel link. Now, back to the main thread. We've talked about ratios, we've talked about demand, we've talked about policy pressure. So what are the next clues to watch? First, watch how silver behaves around this new psychological zone. Does it hold above 100 on pullbacks? Does it snap back quickly when it dips? That tells you whether buyers are using dips to accumulate or whether the move was pure froth. Second, watch gold's relationship to major round levels. When gold pushes into new ranges, it tends to drag the entire precious complex with it: miners, related metals, and sentiment. Third, watch real yields in the bond market narrative. You don't need to be a bond trader. You just need to understand that when real yields fall, meaning inflation expectations outrun nominal yields, hard assets tend to breathe easier. Fourth, watch the dollar, but watch it the right way. Not as up means metals down. Watch it as a proxy for policy confidence. A sliding dollar in the context of aggressive liquidity support can be a powerful tailwind for commodities. And fifth, watch the stories. Watch the media narrative, because the narrative is how the crowd gets guided. When the story shifts from silver is dead to silver is unstoppable, that's when you want to be extra disciplined. Not bearish, disciplined. Now, I want to pause and do something important for the community. If you're watching this and you've had a win, maybe you paid off debt, maybe you built a stack, maybe you made a smart investment move, share your success story in the comments so other people can stay motivated. We have a lot of viewers who feel like they're late to everything. Your story can pull someone out of despair. All right, now let's address a common fear. Does this mean the stock market is about to implode? Maybe, maybe not. And anyone who tells you they know the exact timing is selling certainty they don't have. Here's the more useful lens. If policymakers choose to keep liquidity flowing, stocks can levitate longer than fundamentals justify. That can happen. But the cost of that levitation can show up elsewhere, in currency value, in asset bubbles, in commodity spikes, in inequality, in social tension. So you don't need to predict the crash. You need to build a portfolio that doesn't require the crash to be right. Now, there's another layer here that's easy to miss: geopolitics. When global relationships get unstable, countries and institutions diversify. They don't want all their savings stored in a system that can be weaponized. That's one of the reasons official sector gold interest has been persistent, and it's one of the reasons retail investors look at silver as a smaller, more accessible hard asset. When the world feels unpredictable, people want options. And this is where I'll ask you a second question for the comments. If silver pulls back to retest 100, are you buying that dip, or are you waiting for confirmation and risking that the next leg runs without you? I want to see how people think, because it reveals whether we're early in sentiment or late. Now, let's talk about something practical, because this channel is not here to entertain you with macro poetry. It's here to help you make decisions. If you are in a region where buying physical silver is taxed heavily, you have a few general routes. Accept the tax as the price of ownership, consider legal storage structures that may reduce tax exposure, or focus more on gold if your jurisdiction treats it more favorably. The right answer depends on your goals, your timeline, and your risk tolerance. But here's the trap: doing nothing because it's not perfect. Perfection is the enemy of progress. If your objective is to protect purchasing power over years, you don't wait for a perfect entry. You build a position responsibly over time. Now, let's address the elephant in the room. What if this is a bubble? Silver can absolutely bubble. It has in the past. It can also enter long consolidation phases that make people lose interest. Both are possible. So how do you guard against the bubble scenario? You don't go all in at a euphoric top. You don't leverage. You don't borrow to buy. You don't confuse a trade with a life plan. You build a position size that you can hold even if the price gets cut in half temporarily, because silver has done that before. If you can't hold through that, you don't own silver. Silver owns you. Now, if you're thinking, okay, so what's the base case? Here's my base case. Volatility stays high, pullbacks happen, but the bigger trend remains supported by structural demand, monetary distrust, and policy constraints. That doesn't mean linear gains. It means turbulent gains. And if you want a visual for that, imagine climbing a mountain in a storm. You're still gaining altitude, but you're getting hit by wind gusts and sleet the entire way. The people who only trained for sunshine quit. The people who trained for weather get to the top. Now, I want to circle back to policy one more time, because this is where most viewers underestimate the implications. When the cost of servicing debt becomes politically unbearable, pressure builds to lower rates and to control yields. That pressure is not theoretical, it's baked into the math. And as net interest costs climb, the temptation to solve it through softer money policies grows. The moment the market believes that policy will prioritize liquidity over currency strength, hard assets tend to respond. And that brings us back to silver's move. Silver doesn't need every investor on earth to suddenly love it. It just needs a marginal shift in capital. Because silver is a smaller market than people realize. When money that used to sit in bonds, or speculative tech, or idle cash begins to look for protection, the inflows can overpower the available float. Now, let's talk about the part that nobody wants to hear when prices are rising. Your behavior matters more than your forecast. If you bought earlier and you're sitting on gains, your job is not to get greedy and do something reckless. Your job is to protect your plan. That might mean taking partial profits if your position got too large relative to your net worth. That might mean rebalancing. That might mean doing nothing and just holding. If you're new and you're feeling FOMO, your job is to avoid the all-at-once mistake. Scale in. Give yourself room to be wrong. Don't let a hot chart bully you into bad sizing. And if you're someone who's been grinding, saving, stacking, building, drop your success story again if you've had one. Seriously, this community needs it. Now, I'm going to land the plane with a simple framework you can use this week. Treat the triple-digit silver moment as a regime change signal, not as a buy now or sell now command. Keep your eyes on ratios, silver versus stocks, gold versus stocks, and the Dow to gold relationship for confirmation that the rotation is underway. Listen closely to policy messaging around rates and yields because the bond market is where the pressure lives. Tighten your operational security if you own physical assets. Discretion is part of wealth preservation. And stay humble. Markets can rip, markets can dip, and markets can often make you look wrong before they make you look right. And if you want those bonus links again, they're in the description. The premium WhatsApp channel link and the channel membership join link. Use them. The more chaotic markets get, the more valuable it is to have a direct line to the community. So here's the big question as we end. Is this the moment silver reclaims its role as a core hard asset in the modern portfolio? Or is it just a spectacular detour? Your answer determines your behavior, and your behavior determines your outcome. I'll see you in the next video. And remember, none of this is financial advice. It's educational content meant to help you think clearly, ask better questions, and make your own decisions with your own risk tolerance.